6:14 a.m., June 3rd, 2026. Cook County, Illinois. 47 federal vehicles moved through 4 separate jurisdictions at the same time. No sirens, no lights. Each convoy had been staged since 4:30 a.m., engines idling, radios on encrypted channels. Estimated total, $94 million. Stolen from the retirement accounts of 3,200 municipal workers, plumbers, transit employees, school custodians. The money had been gone for nearly 4 years before anyone noticed. The targets were 11 pension fund offices spread across Cook County. On paper, they were routine financial administrators, the kind that file quarterly disclosures with the Department of Labor and send annual statements to retirees, the kind that pass audits, the kind nobody looks at twice. At exactly 6:14 a.m., agents from the IRS Criminal Investigation Division and the FBI Financial Crimes Task Force executed simultaneous search warrants at all 11 locations. 4 additional warrants went out for private residences. 15 warrants total, served in under 8 minutes. The operation had taken 8 months to build. It started with a single line of code. In November 2025, an IRS criminal investigation analyst named Sandra Kowalczyk was running a routine cross-reference inside the Chicago field office. The task was administrative, matching pension fund EIN filings against a database of known shell entities flagged in prior investigations. It was the kind of work that rarely produces results. Kowalczyk had been doing it for 11 years. On November 6th, at 2:47 p.m., her system returned a match. 3 of the 6 investment trusts listed as portfolio managers for a cluster of Chicago Area Union pension funds shared a registered agent address with a dissolved cryptocurrency exchange. The exchange, registered in Delaware under the name Nexavault Capital LLC, had been flagged in 2022 for potential tax evasion. The case was opened, investigated briefly, and closed without prosecution when the principals dissolved the entity and scattered. 3 years later, the same address appeared again, this time attached to retirement savings for over 3,000 workers. Kowalczyk flagged the match and forwarded it to her supervisor within the hour. By November 8th, the file had been elevated to the IRS FBI Financial Crimes Task Force. The detail that started everything, a single registered agent address in Wilmington, Delaware. What agents would find behind it was something far larger than a dissolving shell company. The 6 pension funds at the center of the investigation were formally named entities, all legitimately chartered, all holding fiduciary responsibility for union retirement contributions across Cook County. Their names sounded unremarkable: Midwest Municipal Retirement Partners, Prairie State Benefits Trust, Cook County Labor Fund Advisors, Allied Workers Pension Group, Unified Benefits Services LLC, and Metro Civic Retirement Associates. Together, they managed accounts for workers in 17 different union locals. Plumbers Union Local 130, Chicago Transit Authority maintenance staff, school custodians affiliated with SEIU Local 73, parking enforcement officers, water reclamation workers. These were not high earners. Most of the affected workers had contributed between $180 and $340 per paycheck for years, in some cases, for decades. The pension was the plan. There was no secondary safety net. The fund administrators had understood that perfectly. What the IRS FBI task force began uncovering in November 2025 was a coordinated financial architecture. The 6 pension funds were the entry point. The real structure was buried underneath. 6 investment trusts registered in Delaware and Puerto Rico, operating under names designed to sound like legitimate fixed-income vehicles. The trusts had no public-facing offices, no listed phone numbers, no employees beyond the registered agents who existed solely to receive correspondence and forward it. Money flowed from the pension funds into the trusts as so-called alternative investments. The transaction documentation was clean, professionally formatted, bearing the signatures of certified investment advisors. Returns were reported back to the pension funds quarterly. Those returns, in most cases, were entirely fabricated. The real money moved in a different direction. Forensic accountants assigned to the task force in December 2025 began reconstructing individual transactions. The volume was staggering. Over 4 years of activity across 6 pension funds and 6 shell trusts, investigators identified more than 14,000 discrete wire transfers requiring individual examination. The task force requested and received authorization for a dedicated team of 9 forensic accountants from the IRS, supplemented by 3 FBI financial analysts. One detail kept appearing in the reconstruction work. I spent weeks reading through the forensic accounting summaries filed in this case, and one pattern repeated across every single fund. The quarterly performance statements sent to pension board trustees were formatted identically to legitimate institutional investment reports. Same fonts, same section headers, same boilerplate disclosure language. The forgeries were not crude. They had been produced by someone who understood precisely how pension board trustees read these documents. Someone who knew that trustees were looking for specific line items in specific places, and who had positioned the fabricated numbers accordingly. The question that nobody could immediately answer: who had built this system? The 6 fund administrators named in the eventual indictment were not sophisticated financiers. 3 had backgrounds in union administration. 1 had previously worked in municipal HR. The financial architecture they were allegedly running required knowledge they did not appear to possess. Investigators spent the first 2 months of 2026 trying to identify who had actually designed the scheme. What's most surprising about this case isn't the scale of the fraud. $94 million is significant, but not unprecedented in federal pension crime prosecutions. What's surprising is how the operational infrastructure was built. The shell trusts weren't thrown together. They were engineered. The Puerto Rico registrations were deliberate, taking advantage of specific provisions in the territory's tax structure to create an additional layer of reporting ambiguity. The Delaware entities were layered on top of those. The registered agent address that had connected to the dissolved Nexavault capital. That wasn't carelessness. That was an oversight. One address had been reused when it shouldn't have been. A single administrative error, 4 years into a $94 million operation. That error became the thread. By January 2026, the task force had identified the likely architect. His name does not appear in the public portions of the indictment filed in June. He remains under a separate sealed proceeding, but his fingerprints were on the structural design of every trust document. A former securities attorney who had surrendered his license in 2020 following an unrelated disciplinary proceeding. He had not stopped practicing. He had simply stopped using his own name. Investigators identified him through document analysis of the trust formation paperwork. Certain clause structures, specific language patterns in the investment mandate sections, matched documents he had filed in his own name before 2020. It was not a forensic signature anyone had thought to look for. It was found by an FBI analyst who had previously worked securities fraud cases and recognized the phrasing from memory. The task force now had a structure, a mechanism, and a probable architect. What they did not yet have was evidence that would hold in court. The second phase of the investigation, running from January through April 2026, focused on building the evidentiary record without alerting the fund administrators. The challenge was real. The pension funds filed regular reports with the Department of Labor. Any unusual inquiry pattern, subpoenas appearing in the wrong sequence, auditor requests that deviated from standard schedules, risked tipping off the targets. The task force worked around this through a method that required patience. Rather than issuing direct subpoenas to the pension funds, investigators built their record from the outside in. Bank records for the shell trusts were obtained through standard financial institution subpoenas, the kind that appear in the normal course of regulatory review. Wire transfer records were pulled from correspondent banks rather than from the pension funds directly. The forensic reconstruction proceeded almost entirely without the target's knowledge for the first 3 months. The obstacle that nearly derailed everything came in February 2026. One of the pension fund administrators, later identified as the most operationally active of the 4 who were ultimately arrested, had a personal connection inside the Cook County Financial Regulatory Office. In mid-February, he made a routine inquiry about the status of an unrelated audit. The person he spoke to mentioned, offhandedly, that IRS CI had been unusually active in the pension sector recently. That comment was enough. Within 5 days, the task force detected movement in 3 of the 6 shell trusts. Wire transfers. Small amounts, under $50,000 in each case, but moving in directions that suggested an attempt to obscure existing balances. The forensic team flagged it immediately. The task force had 2 options: move early with incomplete evidence or accelerate the investigative timeline and risk exposure. They chose a third path. Within 72 hours, they obtained emergency preservation orders on all 6 trust accounts and all 6 pension fund accounts through the financial institution channels already in use. The targets could not move money they didn't know was frozen. The preservation orders were sealed. The investigation continued. What the administrator had triggered with his inquiry ended up helping investigators. The 5 wire transfers he'd initiated provided direct evidence of consciousness of guilt, documented attempts to move funds after proximity to a regulatory inquiry. Prosecutors would later describe those 5 transactions as some of the cleanest evidence in the indictment. The investigation resumed. The timeline accelerated. By March 2026, the task force had established how the money had actually moved. the scheme operated on a quarterly cycle. Contribution payments from the 17 union locals flowed into the 6 pension funds on their standard schedules. A portion of those contributions, typically between 22% and 31% of each quarterly intake, depending on the fund, was then transferred to the shell trusts as alternative investment allocations. The transfers were authorized by pension board trustees who believed they were approving legitimate investment activity. The trustees were not co-conspirators. They were part of the cover. The fabricated performance reports sent to trustees showed returns between 8% and 11% annually. Aggressive, but not implausible for alternative investment vehicles in a low-interest environment. The trustees reviewed these reports in quarterly meetings that lasted, on average, 40 minutes. The fund administrators who were later arrested attended these meetings and answered questions. The certified auditors who had been retained to independently verify fund performance provided clean opinions. The auditors are the subject of a separate, ongoing investigation. 2 of the 3 audit firms that certified the fabricated balance sheets have had their files subpoenaed. 1 has retained criminal defense counsel. Here's the part that doesn't make sense on the surface. How did auditors certify financial statements that were fabricated? The trust accounts existed. The bank statements that accompanied the quarterly reports were real, but they reflected balances that had been temporarily inflated for audit periods and then drained afterward. The technique is not new, but it requires coordination between the people producing the financial documents and the people receiving them. At minimum, it requires auditors who are not asking the right questions. Investigators found evidence suggesting that 2 of the auditing firms received payments through consulting agreements with entities connected to the Shell Trust network. The payments were categorized as financial analysis services. Over 4 years, the total paid to these firms through those agreements exceeded $1. $4 million. That number, $1, $4 million, tells you what the scheme cost to maintain. The gross take was $94 million. What happened to the $94 million is a question that forensic accountants are still working to answer fully as of the date the search warrants were executed. Here is what investigators had established by June 2026. Approximately $31 million had been moved offshore through a series of intermediary transfers that routed through accounts in the Cayman Islands, Cyprus, and the United Arab Emirates. The initial transfers were structured to stay below bank reporting thresholds. $9,800, $9,700, $9,500, repeated across dozens of transactions over several months. The structuring itself is a separate federal crime. Approximately $28 million remained in accounts connected to the Shell Trust network, frozen under the March 2026 preservation orders. The remaining $35 million has not been fully traced. Forensic accountants have identified probable destinations: real estate purchases in Florida, Illinois, and Nevada, luxury vehicle purchases through intermediary buyers, cash withdrawals across multiple states. The complete accounting is ongoing. For 3,200 workers, the status of that $35 million is not an accounting exercise. It is the difference between a retirement and something else entirely. Here's an honest take that may not sit well. The pension board trustees who approved these quarterly investment allocations bear a measure of institutional responsibility that hasn't been fully examined in the public indictment. They were deceived. That is accurate. They were presented with fraudulent documents, and they acted in good faith on those documents. Also accurate. But the standard of care for pension trustees includes independent verification of fund performance, not merely reviewing reports prepared by the administrators being supervised. Several trustees approved alternative investment allocations year after year without ever directly contacting the investment trusts to verify their existence. No site visits. No independent confirmation of account balances. No secondary audit beyond the one their administrators arranged. We'll say what most won't. The oversight infrastructure failed long before the fraud was uncovered. And the people who depended on that infrastructure, plumbers, transit workers, school custodians, paid for that failure with their retirement savings. The search warrant applications filed with the Northern District of Illinois in late May 2026 ran to 847 pages. They had been reviewed by 3 assistant U.S. attorneys and a senior DOJ financial crimes supervisor before being submitted. Judge Carla Hendricks signed all 15 warrants on June 1st, 2026 at 4:22 p.m. The operational plan called for simultaneous execution at all 15 locations within an 8-minute window, beginning at 6:14 a.m. on June 3rd. The simultaneity was essential. If any single target received advance notice, a phone call, a text, anything indicating law enforcement was moving, the others could destroy evidence before teams arrived. The coordination required synchronizing 47 vehicles and more than 130 federal agents across 4 different law enforcement components: IRS, Criminal Investigation, FBI, the U.S. Attorney's Office, Northern District Staff, and Department of Labor Office of Inspector General Investigators. The night before the raid, one of the 4 primary targets failed to return home. His name is not included in the public-facing portions of this account. By 10 p.m. on June 2nd, surveillance teams rotating near his residence noted that his vehicle had not returned. Attempts to locate his cell phone through authorized technical means showed the device had been turned off at approximately 7:30 p.m. The task force convened an emergency call at 11:15 p.m. The options were limited. Moving the raid forward to that night would mean executing warrants before dawn with incomplete surveillance confirmation at multiple sites. Postponing risked the missing target making contact with co-conspirators. A narrow path existed. Proceed as planned at 6:14 a.m., with additional surveillance assets repositioned to watch transit points, airports, train stations, the Indiana state line, while the missing target's associates were placed under priority surveillance overnight. Put yourself in the lead agent's position at 11:15 p.m. 8 months of investigation, 15 warrants signed, 130 agents staged across Cook County, and one target who had gone dark 4 hours before the operation begins. They decided to hold the plan. The raid would execute at 6:14 a.m. as ordered. At 4:47 a.m., a surveillance team outside O'Hare International Airport identified the missing target's vehicle in the long-term parking structure. He had not departed. Additional agents were repositioned. The terminal was covered. At 6:14 a.m., the first teams moved. The raid unfolded across 4 jurisdictions in what supervisors later described as textbook execution. The pension fund offices were commercial locations. No residential complication, no risk of firearms beyond standard agent protocols. Teams entered each location, secured personnel present, and began the evidence collection process. Servers were disconnected from network access before being cataloged. Paper ledgers, printed wire transfer records, and physical audit files were boxed and logged on site. External hard drives found in 2 locations were immediately preserved without examination. Chain of custody would be established at the forensic facility. At the residence of the primary fund administrator, agents located a fireproof safe embedded in a closet wall. It contained $47,000 in cash, 2 passports, 1 U.S., 1 bearing a Caribbean nation seal, and a USB drive. The drive's contents have not been publicly disclosed. Investigators have described it in sealed filings as significantly material to the ongoing prosecution and the parallel sealed proceeding. The missing target was located in the airport at 6:31 a.m., 17 minutes after the raid began. He was at a ticketing counter. The departure he had been attempting to book was to a destination without a U.S. extradition treaty. His ticket was never printed. 4 individuals were placed in federal custody by 8:15 a.m. A 5th person of interest, a financial intermediary believed to have facilitated the offshore wire transfers, was not at any of the targeted locations. As of the date of the search warrant executions, that individual's whereabouts are not publicly known. An arrest warrant is outstanding. One detail that stayed with me reading through the available case documents: the financial intermediary had not been an employee of any of the 6 pension funds or any of the shell trusts. He appeared in the transaction records only as a recipient of wire transfers categorized as advisory fees. He had no formal title, no contract on file with any of the pension funds. He existed in the financial records as a payee name and a bank routing number, until investigators traced those routing numbers back to accounts registered in his name. He is the open thread in this case. The money moved through him, and he is not in custody. The 4 individuals arrested on June 3rd were arraigned in federal court in Chicago on June 5th, 2026. Each was charged with wire fraud, conspiracy to commit wire fraud, money laundering, conspiracy to commit money laundering, and, in 3 of the 4 cases, obstruction of justice relating to the February wire transfers. One defendant also faces charges of attempted flight to avoid prosecution. Bail was requested and denied for 3 of the 4. The 4th was released on a $2 million bond with electronic monitoring, surrender of passports, and restrictions on financial transactions. His attorney described the charges as a fundamental mischaracterization of legitimate investment management decisions. The Department of Labor has notified all 17 affected union locals. Representatives from SEIU, Local 73, and Plumbers Union Local 130 held joint press conferences in the days following the arrests. Union officials confirmed that recovery of funds for affected members would depend entirely on the outcome of the federal prosecution and related civil asset recovery proceedings. Current estimates, based on the approximately $28 million in frozen accounts and the partial tracing of the remaining $35 million, suggest that recovery will be incomplete. Attorneys representing affected workers have filed civil suits in parallel to the federal criminal case. Damages sought exceed the total loss amount, on the theory that the fund administrators and their associates bear liability for investment returns that would have accrued on the stolen principal. The math is unforgiving. A worker who began contributing at age 30 and was scheduled to retire at 65 did not merely lose the dollar amount taken. They lost 35 years of compounding on those dollars. The civil suits attempt to quantify that loss. The number that emerges is considerably larger than $94 million. What does this case tell us about the systems designed to protect retirement assets? The pension fund oversight infrastructure that exists at the state and federal level. DOL reporting requirements, annual audit mandates, trustee fiduciary standards, rests on a key assumption: that auditors are independent, that performance reports are accurate, and that the administrators submitting them have fiduciary motivations. When auditors are paid through side agreements to certify fabricated statements, and when administrators are managing that deception, the oversight system cannot function as designed. It sees what it is shown. The 14,000 transactions reconstructed by forensic accountants in this case were all individually documentable. The fraud was visible in retrospect. The question going forward is whether the monitoring systems that are supposed to catch anomalies in real time can identify this pattern before 4 years pass and $94 million is gone. That question does not have a clean answer in this case. What do you think? Did the regulatory system fail these workers before the fraud even began? Or was this the kind of scheme that could only be caught after the fact? That is not a rhetorical question. The answer determines whether any structural reform is possible, or whether the next version of this scheme is already running somewhere inside a different set of quarterly reports. The prosecutions will move through the Northern District of Illinois on a timeline measured in months, likely extending into 2027. The sealed proceeding involving the alleged architect of the financial structure is on a separate track. Plea negotiations have been reported by legal observers but not confirmed by the U.S. Attorney's Office. The fifth defendant, the financial intermediary with the outstanding arrest warrant, remains unaccounted for. The $35 million in untraced funds remains unaccounted for. Of the 3,200 workers whose retirement contributions form the basis of this prosecution, the oldest cohort, those who expected to retire within the next 5 to 7 years, have been described by union attorneys as facing the most severe financial impact. For a worker in their late 50s who had planned to retire at 63, there is no timeline in which a favorable court verdict restores what was lost. The money would need to be recovered, distributed, and reinvested. And the years that would have been compounding cannot be given back. Will the full $94 million ever be recovered? Comment yes or no, because the asset recovery cases in pension fraud prosecutions of this scale have a historically poor return rate, and this case is no exception. The 4 individuals in federal custody are awaiting trial. The forensic accounting work continues. The DOL has opened a separate administrative proceeding against all 6 pension funds, which are now under court-appointed receivership pending the outcome of the criminal case. The sealed proceeding involving the scheme's probable architect remains sealed. The financial intermediary is somewhere, and somewhere in the offshore account chain. Cayman Islands, Cyprus, UAE. A portion of $31 million sits in accounts that U.S. law enforcement has identified but not yet successfully seized. International asset recovery is slow, treaty-dependent, and subject to jurisdictional complications that defense attorneys know how to exploit. The workers who built their retirement plans around these funds did everything right. They showed up. They contributed. They trusted a system that was designed to protect them and was instead used against them. The system that failed them is largely unchanged. If you want to follow the prosecution as it moves through the Northern District, and there will be significant developments in the months ahead, subscribe now. The civil recovery proceedings alone will produce disclosures that the criminal trial may not. The 4 defendants are in custody. The architect is in a sealed proceeding. The intermediary is not, and $35 million is still missing.